love the channel and find it useful in becoming a happy retiree. Subscribe today. We're going to go back to Jerri. Are you still with us, Jerri?
Yes, can you hear me, Wes?
I absolutely can, loud and clear. I know you're calling from the mountains, and what you may have done is gone overly conservative here. And if you do that, then you have no exposure to the risk side of the market, which is quite frankly where we've gotten all of our return, or most of our return, over the last several years. So I think that's, as a kind of identifying what's going on here, I think that the target date fund you're in is probably just too darn conservative. Now the question is, do you want to make a switch now, right? You're already, you're 60, 62, you're semi-retired, your husband is 60. You're saying he's going to work till at least 70.
Yes.
Does he know that, by the way?
Yeah.
Or did you just tell him he's working till he's 70?
No. Sorry.
Honey, I'm sorry, you've got another 10 years at least.
I know. And you know, we have lots of grandbabies and things that I help out with, and yeah. So anyways, it's a family dynamic.
Got it. Okay. So my thought here is that you have to then you take a step back for a second, and I want you to look at this from a bigger picture perspective and say, well, what's your horizon? Because I think that's one of the key difficulties in investing, and maybe mistakes that people will make, is they'll say, look, I'm going into retirement soon, whether it's a year or 2 or 3 years. You say, I see this happen all the time. Hey, we're going to retire pretty soon, so I want to make sure we're really safe with our money. All that makes sense, right?
Right.
The problem with that is that just because you're retiring next year or in a few years doesn't mean, game over, right? It still it probably means that you've got 20, 25, 30 years left of investing, God willing, right?
Right.
And that's the biggest mistake I see families make, is they think, oh, we're about ready to retire. Let's just dial down all the risk, get really conservative because we don't, quote, have time to make it up. I hear this all the time, Wes, we don't have a lot of time to make it up if things go wrong or the stock market goes down effectively. So the balance between those two is to say, okay, I get that, and that makes sense, but instead of going completely conservative and owning all bonds or all CDs, where you're basically you're not even going to keep up with inflation, right?
Right.
Inflation's at 2%, CDs are paying 2%, so you're effectively making zero. And that may feel okay for a year or two, but exactly what this scenario, Jerri, is you look and you see equity markets have gone up tremendously over the last couple of years. You say, gosh, we really missed out. But how do you get back in, right? And again, the key here is to understand that you're not just investing for the next year or two. You're investing for the next 20. Even though you're 60, you still have a really, really long time horizon. 30 years potentially, God willing, 40 years. You live to your 100. So it's not as though you don't have a 1 to 3 year horizon. You have a 30-year horizon. So remember that. Number two, you still want balance. And I've got a rule we've talked about here on the show called the 15-50 stock rule, meaning that if you have a time horizon that is 15 years or longer, which, Jerri, you do, then I believe over time you should be at least, and this is in my book, at least 50%, in equities, in the stock side of the market. So if you go back and you look at all those target date fund options that you have, and you've got the 2015, the 2020, the 2025, and so forth, it probably goes all the way out to 2045. It's less about the year, Jerri, and more about the mix that's inside that target date fund.
Okay.
And you want to open up the hood and look at the parameters, and you probably want to get some sort of fund that has about 50% exposure. About half of that fund has exposure to equity markets or the stock side of the market. It's usually a mix of U.S. large companies and international. And I think that over the course of the next 10, 15, 20 years, there's a high likelihood that that's where you'll see your best rate of return. It's not easy, it's choppy, markets are volatile, but over time, that's really where you get your real rate of return. The only reason I don't say, again, why not do more? If you think it's going to do so great, Wes, why wouldn't I do more? Well, the answer here is that you've got to have some sort of balance so that you can sleep well at night and you can feel comfortable with it. And usually that means that the other half of the equation is in something that's a lot more stable, or that just pays a steady level of interest, 2, 3, 4%. And it's there as a buffer when the stock side of the market goes down, right? So if we go down 10, 15, 20, 30% on the stock side, the bond side will likely stay flat and maybe even go up a little bit. And that's why we have this vast diversification, 2 totally different kinds of assets. When you mix them together, it smooths out the whole ride. And that's why in principle in theory I like these target date funds. So just take a look at some of your other options and look for one that has a little bit more of a balance, as opposed to having everything in the conservative side of the equation. Jerri from Jasper, thank you for your call. Hopefully that gave you some direction. I think it's a really important conversation that most investors are having kind of at any point. Hey, well, we didn't do well enough. It's probably because you're overly conservative, but you've got to get a balance and exposure to risk within reason. Remember your horizon. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.